Hi, I'm Phil Thompson. Thanks for joining me for Phil's Finance Fix. Today is our 8th video in our shares versus property series, and I'll be discussing the difference in all important investment performance. Shares are better performing asset classes, obviously, because Qantas has increased by 129% over the last 12 months, and in 1 month alone, Perth units have decreased by 4%. But hold on, property is the better performing asset class because Sydney house and unit prices have increased by 15% and Fortescue metal shares have decreased by 48% over the last 12 months. So these two statements are exactly what is wrong when people make investment decisions based off specifically picked stats that justify an opinion. This is similar to when you hear a friend or family talk about how they sold their property for an extra $200,000 above expectation, or bought TPG Telecom stocks 3 years ago and now it's worth 423% more. I'll wrap some numbers around historical performance figures for each investment class. So Russell Investments and ASX release a paper every single year called the Long-Term Investment Report that compares performance on a whole bunch of different asset classes, but we'll look at the residential investment property and Australian shares over a 10 and 20 year period. That includes the value movement and the income return. The 10-year gross performance does vary a bit from year to year, such as 10 years up until December 2011, property was performing at 8% per annum and shares were performing at 6.5% per annum. While only 12 months later, the 10-year performance up to 2012, property was performing at 6.5%, while shares were performing at 8.9%. So they've swapped around. So this just shows that although historical data is important, it can be used to mislead consumers into thinking that one performs better than the other. My preferred option when looking at past performance is to look at a longer investment time frame and also consider tax implications, which we did touch on in episode 6. So if we use the most recent report that the Russell and ASX produce with a 20-year time frame up until December 2014, property's gross performance is 9.8% per annum and shares is 9.5%. So property outperforms by 0.3%. While if you look at the after-tax performance of someone who's on the lowest tax rate, or if it's held within superannuation, shares actually outperform property by 0.8% and 0.9% respectively. While for someone on the highest tax rate, property stays in front by 0.1% per annum over shares over a 20-year period. So AMP's chief economist Shane Oliver wrote a paper in 2012 comparing property and shares since 1926 and determined that shares increased by 11.3% per year and property increased by 11.1% per year. So suffice to say that historically both asset classes have had their ups and downs, and over the long period they both have had really impressive performances and have outperformed almost all other asset classes. The advantages that property does have over shares in the performance is that you have the ability to personally improve the value of the asset by renovating or building an extension or subdividing. While shares, unless you're buying billions of dollars worth of iron ore, you can't improve the value of the BHP shares. And the advantages of shares has over property is that you can buy into an index and you get market returns. While as for property, although the overall market can increase by the 9.8% over the last 20 years, because you can only buy one property in one suburb in the one city, the risk is that your property may provide lower returns than the overall market. All this said, given that performance is similar and past performance has very little bearing on how it will go in the future, I'll put a tick in both property and shares as they have both created incredible wealth for investors over a long period of time. Thanks heaps for watching, and I hope that you can watch next week's episode where I talk about the bias within the market from the consumers, the media and professionals. If you have any questions about this episode, please feel free to email me at phil@thompsonfs.com.au or comment below. And if you'd like these videos to be emailed to you directly, you can do this by subscribing to the YouTube channel, click the cog wheel and then tick send me updates. Thanks again for watching, and I'll see you next week.